Today, I would like to talk to you about the importance of your credit score. Many people believe that a credit score is simply a number that financiers use to determine whether or not to grant you a loan. But your credit score is much more than that. Your credit score also determines what rate you pay on your auto insurance, how much you pay on a security deposit for utilities and other rentals, as well as whether or not you're going to get that new job you applied for. Understanding exactly what a credit score is, how it affects your life, and what you can do to protect your score will help make your life a lot easier. So exactly what is a credit score? Well, Wikipedia defines a credit score as a numerical expression based on a statistical analysis of a person's credit file in order to determine the creditworthiness of that person. There are three major credit bureaus that compile credit files on each of us. They are Equifax, TransUnion, and Experian. Each of these credit agencies may receive different information on you, so your score with each agency may vary. But regardless of the information they receive, they all use the same basic factors to help determine your credit score. Those factors are your payment history, the amount you owe on revolving credit, the length of your credit history, your new credit, and the mix of credit types. The most important factor is the payment history and makes up 35% of your credit score. Credit agencies look at any late payments that have been reported as well as any collections that have been reported. Emphasis is given on your credit history within the last 24 months. With anything older isn't given as much weight. The amount you owe on your revolving line of credit, like credit cards, makes up 30% of your score. If you have credit limits of $10,000 and you have a balance that you owe on those accounts totaling $8,000, you're going to lose a few points of your credit score. In order to keep from losing any points on your credit score, you need to keep the balance owed on your revolving accounts down to 50% of the available limits. The next factor is the length of your credit history, and makes up about 15% of your score. You need at least 6 months of credit and payment history on any account being reported to the credit bureau in order for it to have any weight on your score. The longer your account history, the better it's going to reflect on your score. Many people are under the assumption that if you pay off your debt faster, it'll help boost your score. But that's not always the case. While paying off a 12-month loan in only 3 months may save you some money on total interest charges, it's not going to do a lot for your score because you didn't have it out there long enough to establish any payment history. New credit makes up about 10% of your score. And every time you take out a new loan, you're going to lose a few points on your credit score. But those points will be replenished within a few months of on-time payments. However, if you go back month after month after month and take out more and more loans, you're just sending a red flag to the credit bureaus that you can't manage your finances and that you need to borrow money in order to make ends meet. In order to avoid this, borrow the amount that you need the first time so you don't have to keep going back. And try to avoid finance companies that like to have you renew your loan every other time you come in. This only damages your score even though they try to tell you it helps build your credit. The last factor of your credit score is the mix of credit types, and it makes up the last 10%. There are 3 types of credit: revolving credit, such as credit cards; installment credit, which is your auto loans and your signature loans and other personal loans; and mortgages. Being able to juggle at least 2 of these major credit types will help boost your score. But what does all of this mean for you? Well, the stronger your score is, the more money you will be able to save. According to Fair Isaac's website, the interest rate given to a person with a credit score of 520 as opposed to a person with a score of 720 was 4.36 percentage points. That difference in percentage points on a $100,000 30-year mortgage loan would cost you a difference of $110,325 in total interest over the life of the loan, and have a monthly payment difference of $307 according to Bankrate.com's mortgage calculator. A strong score can even help lower or eliminate any required security deposit for opening up utilities, and may even lower your auto insurance rate because a high score reflects responsibility. And responsibility with your finances reflects responsibility behind the wheel. To improve your credit score, you need to pay your bills on time, keep your credit card balances low, pay off debt instead of moving it to another card, and apply for credit only when you need it. If you miss a payment, get current as soon as possible and keep current. And keep it look out on your credit report and check to make sure there's no inaccuracies. You can get a free copy of your credit report every 12 months by either visiting the website of the credit agency or by going to www.annualcreditreport.com, where you can have access to all 3 bureaus in one place. Once you have a copy of your credit report, take a look at all the trade lines being reported and make sure that they all reflect actual accounts that you have personally opened. And make sure that the payment history on each of those accounts reflects your actual payment history. If you see anything that is inaccurate, first thing you need to do is contact the creditor reporting the information. A lot of disputes can easily be handled just by a simple phone call to your creditor. However, some creditors may require that you file a formal dispute through the credit agency so that they can keep track of it for compliance purposes. In order to file a formal dispute, you need to go to the website of the credit bureau that was reporting the information. If more than one credit bureau was reporting the same information, just pick one of them. They will follow up with each other once the investigation is done. Once you file the dispute, the credit bureau will send the disputed information to the creditor, and the creditor has 30 days to respond. If you still feel that there is inaccurate information once the investigation is complete, you can then contact the creditor directly and work with them one-on-one to resolve it. Okay. There are also several companies out there that for a small fee will help monitor your credit for you. They'll inform you anytime somebody makes an inquiry on your report, anytime a new account is open, and anytime there's a major increase or decrease in your credit score. These alerts can help you keep better track of your credit history as well. So, once you understand what a credit score is and how it is calculated, you can use that information to help build your credit history and boost your credit score in order to save you money. And keep a close eye on your credit history, and reporting any inaccurate information will help make sure that your strong credit score stays that way and makes your life a lot easier.